to figure out how much of the system needs to be regulated and therefore earn a regulated return, and how much can be competitive. So let's imagine how this world might look. And let's take New York as an example. So we already have a deregulated, competitive, central station generation system. So we certainly would still need to have a regulated transmission system and some distribution, because there's only one party that's the natural monopoly. There's only one party that's going to be able to build much of the transmission and distribution system. But then we go to that part of the node which could be competitive, which therefore does not need to be regulated. And that part certainly is the part as you get closer and closer to the customer. You could imagine a world where there are entities offering energy management services, and this is on a non-regulated basis, and so it means that there could be lots of parties participating in that. It could be the non-regulated parts of the utility industry, or it could be new entrants. And really, the nature of this kind of model is it starts to look like other things in the U.S. economy. It starts with the customer and works backwards. Because in the utility industry, it's still a push model. It's because there were no other alternatives. And so now, in this world, and the technology and the capabilities are coming, it can start with the customer, and the customer figures out what kind of solutions the customer wants, and it works backwards to the amount of generation that's needed. And if we get this right, we could wind up building smaller pipes. We could build a smaller transmission and distribution system. Because of right now, again, nobody's worrying about the total customer bill. If we worry about the total customer bill and engage in not only energy efficiency and load leveling, we can wind up having a smaller transmission and distribution system and ultimately less generation as a consequence. And that's how we're going to really lower the amount of carbon we produce. So that sounds all great. But building this, this system around the customers, which would include a lot of smart technology, meters and control systems and distributed generation and more investments in energy efficiency, is going to require lots of capital. And what I proposed here is, in order to create this kind of market, it's going to have to be a competitive market, and we're going to want to attract innovation. So the challenge is that this is going to be an unregulated business. So how are we going to be able to attract this capital? How are we going to fund it? Because some of the service providers may be capital constrained. Even very large companies that are interested in participating in this system feel that they're capital constrained. So the Johnson Controls of the world, and I'm just picking them as an example, they are very interested in getting involved and are involved in energy efficiency solutions, but they are understandably not all that interested in being a financier, and they are reluctant to give too many guarantees because they don't want to put their balance sheet at risk. And then we're obviously talking about a bunch of smaller companies that would love to get involved in providing a range of services, but they don't have balance sheets at all, much less balance sheets to put at risk. It's not only then the quantum of capital that we need to figure out how to mobilize, but it's also the kind of financing products that we would need to offer to customers, because we're talking about energy, and energy is an operating expense. And one of the challenges for people, again, that have been working in energy efficiency is that too often we're asking people to make a capital expenditure, whether they're individuals or companies, to make a capital expenditure instead of having a pay-as-you-go system. One of the things that's revolutionized, obviously, the residential solar market has been the residential solar lease, because people pay their electricity on an ongoing basis as an operating expense, and that's what a solar lease does. But that's the great exception to the rule, because most energy efficiency and other kinds of distributed generation are still require in this market an outlay of capital, as opposed to it being an operating expense. So this is where the green bank sort of starts coming in, because one of the reasons why there are not more lease type products is because we have two problems, two market gaps in financing markets. The first market gap that we have is we have bank capital rules. And many of you are familiar with this. But we, after 2008, we had a financial crisis. What's the solution to a financial crisis? You worry about your banks. You try to impose new rules on banks. Basel III to set up new capital rules. It wasn't designed to hurt the energy efficiency or renewable energy industry at all, not at all. But what it did require is for smaller loans particularly that are below investment grade or marginal investment grade, things that have a long tenor, really difficult to get capital. And it happens to be, unfortunately, the sweet spot of the energy efficiency and renewable energy industry. So capital is constrained from banks. The second thing is that there aren't really many capital markets instruments. In fact, very few. There are some large bonds that have been done for very large projects, a solar project or a single wind project. But when you think about trying to think about energy efficiency projects or small solar projects, there are people working on all this stuff, but there are no capital markets instruments. Securitization, which is how we deal with credit cards and all kinds of other things, create bonds through securitization, doesn't yet exist for energy efficiency or for smaller renewable energy projects. So if you have capital that's constrained because of bank capital rules, and you don't have capital markets, it means that financing is constrained to the sector, and it means that financing options are also constrained. So this is where I think the Green Bank in the state of New York fits in, because our objective is to work in sectors of the market where there are customers that are making progress, or intermediaries that are making progress with customers in the market, where their ability is, or their growth is limited by the lack of availability of financing, not the cost of financing. We don't want to be in the subsidy business. The reason why we don't want to be in the subsidy business is because if you're in the subsidy business, you're going to run out of money. Number two is you're not leveraging private sector. And number three, you're not moving the needle. So because of these kind of market gaps that we see, what we really want to do is to move financial markets. We want to be about one standard deviation, as it were, from where financial markets are. So if there are entities in the market that are making progress with customers, and these could be financial institutions themselves, they could be manufacturers, they could be service providers, they could be community groups. Eventually we have to find a financial institution that, in exchange, for example, for a credit enhancement that we could provide, they would lend more than they would otherwise do. And you can see that not only will you get leverage, but if over time it's demonstrated that that market is an attractive market, then it means that the state can move out of the way and the private sector can take over the opportunity on its own. So we can also be involved in helping to create securitized markets. The reason why we don't have securitized markets is a lack of data and a lack of standardized contracts. So in exchange for providing concessionary financing and also the ability to do aggregation, we can help create securitized products. So again, what we're already, you can see the outlines of this whole picture, because you already see what's going on in the solar industry. You see that the solar industry, residential solar industry, and others in the solar industry are using innovative financing techniques to be able to provide alternative solutions to customers. And as I said before, the effect of that is to reduce the reliance upon the utility industry. And so the Green Bank is going to be working in ways to be pro-competitive for these different business models. And when you add all the pieces together, you can see a future where, if we get this right, we're going to have a system where there are going to be many more actors that are involved on the customer side on an unregulated, competitive basis, and they're going to need financing solutions. And so the last thing I'm going to say is that that with respect to some of the people in this room, because I've had some conversations with some of you, the Green Bank, you should think of us as also being a partner potentially to some of you, because we're going to have $1 billion. That's the only amount of money we're going to have. Our capitalization is coming from ratepayer funds that will be reprogrammed from existing programs to the Green Bank. And therefore, we can only really invest in things or lend to things or provide credit enhancement to things that are going to generate a rate of return, and things are going to generate, and things are going to be safe. Because, and having worked at the Department of Energy after Solyndra, I can tell you, I don't want to be in that business. And we're focused in on areas where there's a lack of availability of financing, as opposed to wanting to be in a business where we're providing subsidized financing. So we're going to be generating assets that earn a rate of return. Ideally, we want to earn a market rate of return. But we don't want to be in the business of tying up our balance sheet for very long, because we're going to have to turn our balance sheet over in order to get leverage. So you might think about us as being a possible partner or asset manager for you. Because one of the challenges, and the reason why, and I've had conversations with many of you, is that you'd say, well, look, I'd love to put money to work in this sector, but I can't seem to get the assets. Well, I think one of the reasons for that is that there's no asset management industry that has an incentive to collect these kind of assets, because because the current structure of the asset management industry and the carry scheme, the assets that we're talking about in terms of energy efficiency assets or renewable energy assets,